Partnerships are actually one of the most common business formations to ever exist, all right? Partnerships can start with no legal documentation filed. If two people get together and they're like, yo, you trying to run this business? I'll help you, you help me, we'll run it together. Boom, partnership, okay? If you have more than one owner on an LLC, boom, partnership, okay? Partnerships are very common. Mostly in the multi-member, that's what it's called, a multi-owner, multi-member LLC. Probably one of the most common forms of partnerships. But partnership tax is pretty much all the same for general partnerships, multi-member LLCs, limited liability partnerships, and so on and so forth. So let's dive into some partnership tax because I know how much you guys care about that. So you've got your partnership over here, and then let's say that for the taxable year, the partnership's taxable income was $100,000. Okay, we're just going to keep the numbers simple as possible here. You got two partners who own this partnership, John and Bob. And again, to keep the numbers simple, let's just call them 50-50 partners. So what does it mean that this partnership profit flows through to these two people? What happens here? So basically what happens is the partnership will earn its profits and the partnership itself will not be charged a tax. What will happen is this $100,000 will get distributed to the two partners who are involved according to their profit allocation. You can have a different partnership interest percentage than your partnership allocation, but let's not complicate stuff. So anyways, 50-50 partners all the way around, profits and losses shared equally. The taxable, basically this $100,000 will flow through 50 to John, 50 to Bob. Now, like I said, the partnership is not taxed on this $100,000. If this was a C corporation, there's a 21% tax here on this $100K, and then there would be dividend taxes on this $50,000. That's the double taxation. However, flow-through entity status means that this $100,000 flow through to John and Bob. They will pay $50,000 of income, and Bob will have $50,000 of reportable ordinary income. Now, one thing that's really important to mention about partnerships is maybe you've heard me talk about S corporations before and how a really big advantage of an S corporation is that they avoid self-employment tax on the business's profits. So one benefit that a partnership does not have compared to that of an S corporation is the ability to pay W-2 wages to its owners, okay? Because this $50,000 and this $50,000, unless it is rental income, this $50,000 will be subject to ordinary income taxes as well as self-employment taxes to John. Same thing for Bob. Okay, now in S corporation, this would be a little bit different. I've made videos in the past about how an S corp saves in taxes a little bit, so just please go refer to that. I don't want to try to mix up this video too much. So back to partnerships. Partnership has its taxable income that will flow through to the partners and only be taxed once at the individual level. Now, let's talk about basis for a second, and how does that affect the basis of the two partners involved in the partnership? So let's say that when John and Bob went ahead and started this partnership, they both just contributed $1,000 for their 50% partnership interests. Okay, so you start with zero basis, and then it will go up by money that you put into the partnership. So then their $1,000 contribution adds $1,000 to their basis. Now you have that taxable income, and the way that it flows through to the partner, it will also add to their basis. So now you have an increase in your basis respective to your distributive share, is what that 50 grand is called. Why is my vision so blurry? You will receive an increase in basis respective to your distributive share in the partnership. So John and Bob both get a $50,000 bump in basis for the year. So then this happens. Now they have $51,000 in basis. Awesome, right? They have $51,000 in basis. But one thing that really needs to be pointed out is that this flow-through tax will happen whether or not the partnership actually distributes John and Bob any profits. This $100,000 worth of profit could still be inside of the partnership, and the partners will still have to pay their tax on the distributive share from the partnership. This is normal. This happens with LLCs. This happens with S corps. This is just how the flow-through tax works. Doesn't matter if you take the money out or leave it in there. The partnership income will be distributed accordingly, and then you will be taxed on that accordingly, whether or not the partner actually received the cash. Okay, so that'll kind of bring us back down to here. Now these two people have they each have $51,000 in basis. So let's say, okay, all right, John and Bob, they agree and they're like, I don't need $50,000 this year. So let's just say that we take a distribution in December for $25,000 each. Okay. Each of the two partners, Bob and John, now they take a distribution of $25,000 each. Now they're actually, meaning that they're actually going to take money out of the partnership now. John's going to get $25,000, Bob's going to get $25,000. So the first thing that you're going to want to do is go see if you have enough basis to cover this distribution. You have enough basis to cover this distribution, $25,000, $25,000. You can see here that they will still have $26,000 in basis left over, meaning they each of them received this $25,000 tax-free, okay? This $25,000 came out of the partnership tax-free. The taxable income flowed through up here. You could take this distribution 3 years later, and as long as you have enough basis, that money will come out tax-free. As long as you have enough basis, as long as your basis exceeds the amount of the distribution, the money will come out of the partnership tax-free. Now, so what's going to happen if we took, $60,000 each, okay? Say you take $60,000 each. So then this goes away, this goes away. What's going to happen? You got $60,000 now, which is a difference of $9,000 in excess of your basis. Same thing over here. So what happens to this partner is now you have additional income that you're going to be taxed on equal to $9,000. Of the 60, $51,000 came out of the partnership tax-free. You got that to the extent of your basis. However, this $9,000, which is the amount in excess of your basis, is going to be taxed to you again, double taxed, and you're going to pay capital gains tax rates on the amount withdrawn in excess of your basis. So that is how partnerships and S corps, for that matter, can actually face double taxation and lose the benefit of their flow-through status. Now, how in the beginning of this video I was comparing partnerships to sole member LLCs. This is because sole member LLCs do not have to worry about this. They don't have to worry about the basis in their company. S corps and partnerships do. General partnerships, limited liability partnerships, you have to worry about what is your basis inside of the partnership in order to take any money out and avoid double taxation. Another reason why you need to pay attention to your basis is, okay, let's say that you guys opened up a partnership, contributed $1,000 each. After a year, the partnership earns $100,000. You each get taxed on $50,000 each according to your partnership interests. And then your basis steps up to $51,000 each. Now, let's just pretend that you guys aren't going to distribute any money, so forget about distributions for a moment. And now let's just pretend that you guys are going to sell your partnership interests. What's going to happen if you sell your partnership interests? Well, here's a pretty cool thing about knowing your basis. Let's say John, wakes up one day and he's like, you know what, Bob, kind of over this stuff, man. It was fun for a year, but no longer interested, get me out of here. So John goes about, okay, he's either going to sell it back to Bob, or John's going to try to find somebody else and sell his partnership interest to him. Anyways, nonetheless, John didn't contribute $1,000. The partnership earned $100,000 under his watch. His respective share was $50,000. His basis in this partnership is $51,000. John wants to go sell his partnership interest. John can sell his partnership interest for $51,000 or less and have that sale be tax-free, okay? This basically works like it's your basis, people. A sale price minus basis equals gain. And you do get gain treatment when you sell your partnership interest. So John comes over here and he's like, all right, I'm going to go sell, I'm going to sell it for $70,000, $51,000. Your gain on the sale of your partnership interest is $19,000. That's a 1. I almost wrote a 2. Is $19,000. That's your gain on the sale of your partnership interest. So if you know your basis and you don't want to pay any taxes, just sell your partnership interest for the amount equal to your basis. You'll walk away with that sale $51,000 tax free. Who doesn't like that fee? Tax fee. Tax free if you sell your partnership interest in this situation for $51,000. Now, I hope that gives you a brief introduction as to how to kind of calculate your basis, and then why your basis is also important. It will help you avoid being double taxed when you take money out of your partnership. And then if you ever want to sell your partnership interest back to the partner who's already involved with you, to a third party, unrelated, blah, 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 your basis comes into play when you sell your partnership interest too. And why would you not want to know that? Why would you not want to know how to avoid double taxation and how you can get away with a tax-free sale of your partnership interest? Now, one thing that is a little bit different in calculating basis for a partnership compared to that of an S corporation is liabilities. Liabilities are incorporated in the calculation of your basis in the partnership interest. So to generally sum it up, your basis in your partnership will go up by contributions, up by taxable income to the partnership, down by any losses, down by any distributions that you take. Another thing to figure in here too is non-deductible expenses that come out of your partnership. Those will also reduce the basis in your partnership. A non-deductible expenses, for example, is let's say you have meals expenses that are only 50% tax deductible. Well, 100% was paid by the partnership, right? So that 50% of that meal expense that is not deductible on your tax return reduces your basis just like a distribution. When you hear of a non-deductible expense and you're trying to relate it to basis, just think about it as a personal distribution. It works the same way. It's going to lower your partnership basis. So now let's talk about basis just a little bit more. So we got basically that same example. Two partners, John and Bob, 50-50, contribute $1,000 to start the partnership. Partnership earns $100,000. Their distributive share is $50,000. That'll increase their basis by $50K. No distributions. Let's forget about that for a second. Now, we're going to throw a liability into the mix. Let's say that this partnership incurs a liability. So this could be a general liability on the partnership. This could be credit cards. This could be like a mortgage on a property. This could be numerous things. Any type of this could be a member loan, an owner loan, money that you loaned to the company. Any liability here that the partnership has on their books also will increase the basis of the partners. It is the partner's share of the liability will also increase the basis of the partners. So there is a difference in liabilities between recourse and non-recourse liabilities. We won't get into that. Non-recourse debt is a bit more complicated and may not receive the same increase in their basis. So let's just talk about recourse debt, which pretty much every single debt in a partnership has recourse to it. What does recourse mean? That the owner is individually liable for the debt. Like even if you have a limited liability partnership, or if you're a multi-member LLC, like yes, in the title you have limited liability, but look at all your financing agreements, okay? Is that company really only loaning it to the business? No, probably not. There's probably, you know, something in the fine print of your note that you need to read that says, you know, such and such is individually personally liable for this. So that is recourse debt. Non-recourse debt is debt that you personally are actually not liable for, which honestly isn't that common, but allocating non-recourse debt to partnership basis gets a little bit complicated, and it can only happen in certain situations if you have certain things inside of your partnership agreement. But non-recourse debt, nevertheless, will always be allocated to basis no matter what. So let's just focus on recourse debt and go from there. So that brings us back here. This partnership during the year incurred a $50,000 liability. Basis in your partnership also goes up by your respective share of all partnership debt. All partnership debt. This is a big difference compared to that of an S corporation, okay? So in this case, liability, $50,000, their respective shares, 50% of that liability. They will each receive basis increases because of that debt that was incurred by the partnership of $25,000. So now we're looking at $76,000 in basis, okay? In basis. Just because you have a liability. Your partnership, you guys contributed $1,000 each. Partnership earned $100,000, 50 each. And then you guys the partnership went into a little bit of debt. And you got a $50,000 liability. Why is that so blurry? I hate that. And then you guys went and got a $50,000 liability. I'm really trying to fix it, guys. Hold on. Come on. Man, these phones bother me sometimes. All right, there we go, and we're back. So yeah, and you know, so instead of it only being contributions and income, it will also increase by the partner share in the partnership liabilities. This does not happen in an S corp. A shareholder of an S corporation will only receive that basis increase for a shareholder loan to the company, okay? Meaning the shareholder we'll just say $1,000, took $1,000, loaned it to the company, expects to be paid back. That is the only way the shareholder owner of an S corporation receives an allocation of debt basis. It's called your loan basis if you're talking about an S corp. This is technically referred to as your outside basis. This is the outside basis of the partnership. All partnership liabilities cause an increase in basis. So I mean, seriously, how cool is that? Okay, so now let's apply some of those same situations that we did earlier to this, right? So let's say that, to bring it back to some previous examples that we had, remember how they were going to distribute $60,000 each to each of the partners in this situation before the partnership had debt, and our basis was merely increased by contribution income of the partnership. We had $51,000, distributed $60,000 to each partner, and then the partners got double taxed on that $9,000 that was in excess of their original basis. Well, guess what? Since the partnership went and incurred that $50,000 liability, now the two partners have sufficient basis. We can take that $60,000 distribution now tax-free. Tax-free. We can take that tax-free now. This money comes out tax-free. All because of that partnership liability. Let's say that this was an S corporation. Okay, let's just pretend that this was an S corporation. S corp has the exact same situations. 50-50 shareholders, taxable income $100K. General business liability of $50,000. Not a shareholder liability, a general liability. They do not receive this. Owners of an S corporation will not receive that $25,000 bump in their basis. Partnerships will, not S corps. So if you take that $60,000 distribution and this was an S corp, you're going to get taxed on that $9,000 from before. You're going to get taxed on that $9,000. Since your partnership got that debt, that money's coming out to you tax-free, all of it. All of it. And then let's say you want to sell your partnership interest. Again, your basis is now $76,000. Now you can sell it for all the way up to $76,000 tax-free. Tax-free. Before, we could only sell it for $51,000 tax-free. If you sold it for 70, you had a gain of 19. Once you allocate the liability of the partnership, that you could sell it for $70,000 and take a loss. You could sell it for $70,000 and take a loss on that sale. So not only would you get this 70 grand tax-free, but you'll have a $6,000 capital loss to report. That's huge. That's huge. This doesn't happen in an S-Corp. That right there, that allocation of liabilities to partnership basis is like I said, it's one of the biggest differences between owners of an S-Corp and owners of a partnership. If you ask me, it's way more beneficial in that sense to have a partnership than it would be for an S-Corp. But now, since you guys are getting a little bit aware of basis in your partnership, now here's one thing that does suck about that allocation of the liabilities to your basis. Let's say the company pays the debt down. Let's say the company pays the debt down. The partnership, right? They paid down the debt. That will reduce your basis, okay? You had a liability of 50, so you got 25 grand allocated to each partner's basis. Then let's say the partnership pays the liability from 50 down to 40. Now your share of the liability is only 20. Now you're going to receive a $5,000, is that right? 10? $5,000 reduction in basis. Yes, 5 grand, I'm right. You're going to receive a $5,000 reduction in basis. Let's talk about how this can kind of screw you really fast. So let's go ahead just back to our normal example, and then let's say that the partners went ahead and they took this $60,000 distribution each. Okay, so their basis was 76. They took the money out tax-free, wasn't not in excess of their basis. They have $16,000 in basis left. Now, let's say the partnership itself decided to pay this liability from 50 down to 10 grand. So the partnership paid this liability off by $40,000. The liability in the partnership now is $10,000. Uh-oh. So your change in your allocation of partnership liabilities just went from 50 to 10, down by 40. Your basis will go down by this decrease in your liabilities. So that would be $40,000 in the decrease of your partnership total liabilities, 50/50. That works equivalent to a distribution. Uh-oh, I hope you guys are seeing the problem. $4,000 in excess of your basis. You didn't even have to take any money out of the partnership. The partnership didn't have to earn any money. All it had to do in this situation was pay down the liability, and it will force the partners to recognize a capital gain on this $4,000, the amount that came out in excess of your basis. All right? In excess of your basis. So, again, why is that useful? Well, let's say, you're getting close to year end. You don't really know what your basis is yet, but the partnership's got a little bit extra cash in it. And you just, you say, okay, partnership, pay down some debt. Pay down some of your debt. I want to get that debt out of there so we can try to take some more cash home next year and the years after. Well, you just went and paid down the debt. And if you paid it down in excess of your basis, you're going to get taxed on that. Capital gains on the amount that is in excess of your basis, like I just showed you. You're going to get taxed on that. You didn't even do anything. The partnership didn't earn any more money. You didn't take any money out. All the partnership did was pay off of one of its liabilities, and you get taxed, depending on what your basis was in that situation. So that is a brief, if you want to call it, introduction to basis inside of your partnership. It does differentiate quite a bit once you dive into the weeds from that of an S-Corp, but in theory it's pretty much the same. One thing that you should just take away from this video, at least, and you should just know this off the top of your head if you're the owner of a partnership, you should just know this. my basis goes up by money I put in to the partnership, by my taxable share of the ownership profits. Okay? 50-50 partners, partnership earns $100,000. Your ownership share of that 100K is 50K. Your basis goes up by 50K. Up by your share of net income, taxable income, not net income, sorry, taxable income. Up by money that you put into the partnership or property. Down by distributions. Oops, sorry, I've forgotten up, didn't I? Up by contributions into the partnership. Up by your percent share of the partnership's taxable income. Up by your partnership share in all of the partnership's liabilities. All of the partnership's liabilities, from mortgages down to credit cards. Those three things, and others that we won't get into, those three things will increase the basis in your partnership interest. You want a higher basis. I don't know if you learned that from here or not, but your goal is to have a huge basis, okay? That's just think, when you hear basis, think tax-free. When you hear basis, think tax-free. Basis, tax-free, basis, tax-free. Cool. Up by contributions, up by the partner's share of net income, taxable income, up by the partner's share of the liabilities of the partnerships, all of them, not just owner liabilities, all of them. Your basis will go down by any partnership losses. Your basis will go down by any distributions. And your basis will go down when the total liabilities of your partnership decrease for the year. They don't necessarily just go down if you just pay off a liability. If you paid off a liability, but you got another liability, depending on the difference in the total liability, that's what will affect your basis. The liabilities aren't looked at on an individual basis, they're looked at on an aggregate basis. You can have 10 different mortgages. All 10 of those get totaled up and add to your basis. All of them. It's awesome. Basis is sweet. And lastly, your basis is also important because you cannot deduct losses in your partnership unless you have basis. This situation is actually identical to that of the owner of an S corporation. So for example, let's just forget about that liability for a second. And then let's change this $100,000 to a loss. Let's say it's a $100,000 loss. John and Bob over here, they contributed their $1,000 just like in the prior example. But now they have this loss that flows through. Can they deduct this loss? Only to the extent of their basis. Only to the extent of their basis. Their partnership has a loss for the year, 50-50. They will each get allocated a $50,000 loss. Loss. Basis never goes past zero, people. Basis will never go past zero. Negative, I meant. Basis will never go negative. So then this difference of $49,000 now is a suspended loss. This works the same way in an S corporation too. That $49,000 is a suspended loss. Suspended loss will carry over indefinitely until it's used. How do you use that? Okay, John and Bob now both have a $49,000 suspended loss. Year two comes in and they do earn 100K. They flipped, complete 180, 100K. Now they have 100K in profit in year two. Getting cool, aren't we? So what? 50K, right? 50K. This loss now gets applied against this income. Bam. You only have $1,000 of taxable income to report as the partner in this partnership. You have one. Contribution in year one was $1,000. Year one loss, your partnership share was 50K. Basis can never go below zero. You got a $1,000 loss to deduct on your individual return in year one from the partnership because that was all your basis was. $49,000 of the loss got suspended. In year two, your partnership earns $100,000. Your distributive share to each partner is $50,000. This will go against that suspended loss And then in year 2, even though your partnership earned 100K, your income was 50K. Because of that suspended loss, you will only pay tax on 1K. That right there, that suspension of loss, works the exact same for an S corporation too. You cannot take losses in excess of your basis. So I will wrap this up finally with something I've already said before. Basis, up by contributions, money that you put in. Up by taxable profit that the business earns to your respective share. $100,000 profit, 50% owner, $50,000 added to your basis, S corp or partnership. Benefit of a partnership, it also goes up by your respective share in the partnership liabilities. $50,000 debt of the partnership, 50% partner, your basis goes up by 25 grand just because the partnership has a liability on it now. Down by distributions, down by losses if you have enough basis. Otherwise it goes to 0 and your loss will get suspended, just like I showed you. And then down when your partnership pays off its liabilities as a total compared to the prior year. You have $50,000 in debt at the end of year 1, then you have $25,000 in debt at the end of year 2. Your partnership interest will go down by the respective share of that total $25,000 increase. So that would be $12,500 that your basis goes down by. That is a brief introduction into partnerships.